Welcome to WTS Lectures. Our first lecture is about financial reporting. What is financial reporting? Financial reporting is the way of recording, analyzing, and summarizing financial data. What is financial data? Financial data is the name given to the actual transactions carried out by a business. Example: sales, purchase of goods, payment of expenses. Now you can see that financial reporting is, in brief, the way of recording, analyzing, and summarizing all operations carried out by a business. The second question: what is business? Business, of whatever size or nature, exists to make a profit. The profit is the main purpose and aim of the business. There are three types of the business. First, sole traders. Sole traders are persons who own and in meantime run their own businesses. This is the oldest and most straightforward structure for a business. Sole traders are people who work for themselves. The second type is partnership. Partnerships are agreements between individuals to carry out on business in common with a view of profit. Partnership, however, involves obligations to others, and so a partnership is usually governed by a partnership agreement. Both partnership and sole traders are unlimited liability companies. They are liable for debts and assets of the company with their own properties. But the third type of the business is limited liability company. Limited liability companies are incorporated to use advantage of limited liability. It means that shareholders are only responsible for the amount paid for their shares. They are not responsible for debts of business unless they give personal guarantee. Limited liability company is a separate legal entity from its owners. There are clear distinctions between shareholders and directors. Shareholders are owners of the business. Directors are those charged with governance. Next slide, we will see what is governance. Governance is the responsibility of directors, managers of the company, who are taking day-to-day running of the business. They are legally responsible for protecting and increasing the shareholders' wealth. They must use all their best practice, all their knowledge, all their abilities to protect and increase the shareholders' wealth. The another responsibility of directors: they are responsible ultimately for the financial statements. They are responsible for applying financial reporting standards and reporting framework. They are responsible for detect and prevent fraud by internal controls. Now let's look at the difference between financial reporting and managerial reporting. Financial accounting. Financial accounting, issuing reports, which is for the use of persons who are not day-to-day involved in the running of the business. They are getting information about business. These persons are shareholders, which want to know the position and performance of their company. Trade contacts, which want to know if the company is healthy enough to pay its debts and or to supply goods for its customers. Providers of finance, for example banks, want to know is the company reliable to loan money to them. Tax authorities want to know tax position of company. Employees want to know future prospects for their career perspectives. Financial analysts, which give advice to potential shareholders, and government and public. All financial accounting reports are addressed to these persons, but management accounting and managerial reports, they are not historic reports as financial accounting. Management accounting is reports for managers use in order to take decisions for better running and developing the company. This is reports and information for future prospects. Now let's look at the main financial statements and watch what they are including. There are two main financial statements. It's statement of financial position and statement of comprehensive income. Statement of financial position is more widely known as balance sheet. This is the balance between assets and liabilities. This is a snapshot of the company's position for the particular date of time. For example, it's a photography which shows in the end of reporting period, for example at the end of the year, what are the business assets and liabilities and what is the remaining equity for shareholders. What are assets? The first element of the financial position. Assets, something that business own and use and control and expect future prospects and inflow benefits from them. Liabilities is debts of the company. Company is owed to someone else and which will take out benefits from the company. The residual interest in the company after deducting liabilities from the asset is capital or equity. This is capital or equity is something that company owe to its owners. It's company's liability in front of shareholders. Shareholders own the residual capital and equity of the company. If company is profitable and assets increasing and liabilities decreasing, capital and equity is also increasing, and it also increases wealth and capital of shareholders. The next financial statement is statement of comprehensive income, more widely known as profit and loss statement. It's a statement which shows income and outflow of the benefits from the company in the particular period of time. Statement of financial position is a report for a date, for a particular date. Statement of comprehensive income is a report for particular period of time. In this period of time, statement of comprehensive income shows revenue, which means all inflows from the operation, sales of goods, rendering of services, and expenses. Expenses is all costs of the running the business, and difference between revenue and expenses is profit and loss. This was the brief information about financial reporting and financial reports and their elements. We hope that it gives a little comprehension to you and you enjoyed time spent on it. Thank you for attention.